I'm Andres, and today we need to talk about one of the strangest wealth events happening in 2026 Maybe thousands of ordinary people are about to get rich from SpaceX. Not because they bought a rocket. Not because they day traded a meme stock. Not because they had some secret Wall Street connection. Many of them are engineers, technicians, software workers, operations people, former employees, and even regular staff who simply held on to equity while the company was still private. And that is the part most people misunderstand. When people hear SpaceX IPO, they imagine retail investors clicking buy on day one and becoming rich overnight. But that is usually not how IPO wealth works. The people who get rich first are almost always the people who owned the company before the public ever had a chance to buy it. And in SpaceX's case, that group may be sitting on one of the biggest private company wealth explosions in modern history. Reuters reported that SpaceX priced a record IPO at $135 per share, selling 555.56 million shares, raising $75 billion, and valuing the company around $1.77 trillion. Existing reports also say SpaceX had earlier private tender valuations far below that, including an $800 billion valuation in late 2025, which means people who received equity years earlier may be seeing the value of their shares multiply before the public market even opens fully. And that is why this story matters. Because this is not just a story about rockets. It is a story about how wealth is created quietly before everyone else is allowed into the room. Picture a SpaceX technician in 2016. He's not famous. He's not on CNBC. He does not have a finance podcast. He's working long hours. Maybe missing weekends, maybe sleeping badly. Maybe telling his family, I know this job is intense. But the equity could mean something one day. At that time, the equity does not feel real. It is numbers on a portal. It is stock options with paperwork. It is something you cannot freely sell because SpaceX is private. The rent is still due. The car still needs repairs. The student loans still exist. On paper, he owns a tiny piece of a rocket company. In real life, he's eating leftovers and wondering if the stress is worth it. Then SpaceX keeps launching rockets. Starlink keeps expanding. Private valuations keep climbing. The company holds tender offers where insiders can sometimes sell pieces of their holdings. And then, in 2026, the company reaches the public market at a valuation that would have sounded absurd years earlier. Suddenly, that tiny equity grant is not tiny anymore. Suddenly, the thing he almost ignored becomes the most valuable asset he owns. And suddenly, the coworker who drove an old car, skipped expensive vacations, and quietly kept his shares, may be wealthier than the manager at another company who earned a bigger salary but never owned anything. This is the hidden difference between income and ownership. Income pays your bills. Ownership changes your balance sheet. And SpaceX is becoming a giant example of that difference. Most people spend their lives focusing only on salary. They ask, how much does this job pay per year? That matters, of course. But the wealthiest people in the economy are not usually the people with the highest monthly paychecks. They are the people who own pieces of things that become much more valuable over time. A salary is linear. You work 1 month. You get paid 1 month. Equity is different. Equity can sit quietly for years doing nothing visible. And then one liquidity event can compress 10 years of upside into one moment. That is what is happening here. The SpaceX employee who accepted equity years ago was not just accepting compensation. They were accepting risk. They were accepting illiquidity. They were accepting the possibility that the shares might never become easy to sell. They were accepting the possibility that the company could fail, that rockets could explode, that markets could turn, that regulators could interfere, that the IPO might never happen. And that is the part people forget when they see the millionaire headline. They see the reward, that they do not see the waiting period. They see the big number, but not the years where the number could not pay for groceries. They see the outcome, but not the risk. And this is why 2026 is such a turning point. Because when a private company becomes public, the invisible becomes visible. The private stock that used to be hard to value suddenly has a public price. The employee equity that was trapped behind company rules suddenly becomes easier to convert into real money after lockups and restrictions. The wealth that existed only on paper starts becoming liquid. But here's the twist. The public investor buying after the IPO is not in the same position as the employee who got equity years ago. They are entering at a much higher valuation. They are buying after much of the early appreciation has already happened. That does not mean SpaceX cannot go higher. It might. It has rockets, Starlink, government contracts, launch dominance, and a brand that no other space company can match. But the risk-reward is different. The early employee was paid partly with uncertainty. The public investor is paying for certainty that already became expensive. That is why the headline "People are about to get rich off SpaceX" needs a careful explanation. It does not mean everyone who buys the ticker in 2026 becomes rich. It means the people who were already owners before the IPO may finally be able to realize wealth that has been building silently for years. And this same pattern has happened again and again in American capitalism. Microsoft did it. Google did it. Facebook did it. Nvidia did it. Tesla did it. Ordinary early employees, not just founders, sometimes became millionaires because they owned small pieces of something that scaled globally. But most people only notice after the life-changing part has already happened. They notice the IPO celebration, not the decade of compounding before it. They notice the public listing, not the private sacrifice. They notice the wealth, not the ownership structure. And that is the financial lesson. Getting rich is often less about finding the perfect stock after everyone is talking about it, and more about owning the right asset before the crowd understands what it is becoming. Now, let's be honest. This does not mean everyone should run to a startup and accept low pay for lottery ticket equity. That is a dangerous oversimplification. For every SpaceX, there are hundreds of startups where the equity goes nowhere. There are employees who worked long hours, accepted options, believed the pitch, and ended up with shares worth nothing. Equity can be powerful, but it can also be a mirage. The difference is that SpaceX became one of the rare companies where the mission, execution, market dominance, and investor demand all lined up. It built reusable rockets when many people thought that was impossible. It turned satellite internet into a global business with Starlink. It became deeply important to commercial space, defense, communications, and national strategy. And that combination made the equity far more valuable than a normal startup lottery ticket. But even then, the workers had to hold. And holding is harder than people think. Imagine having shares that are worth hundreds of thousands on paper, but you cannot easily sell them. Imagine friends telling you to cash out in a tender offer. Imagine worrying that the valuation is too high and could crash. Imagine needing money for a house, medical bills, or family obligations. Holding is not passive. Holding is emotional labor. It is the discipline to not sell too early, and also the wisdom to know when to reduce risk. Some SpaceX employees may become millionaires because they held long enough. Others may have sold earlier at lower valuations and still done well, but not as dramatically. Others may have left before vesting enough shares. The same company can create completely different financial outcomes for people, depending on when they joined, how much equity they received, how long they stayed, what they exercised, what taxes they managed, and whether they could afford to hold through uncertainty. That is why equity wealth is never as simple as a headline. Two people can work at the same company and have totally different results. One person joins early, receives meaningful options, stays through multiple valuation jumps, and holds. Another joins late, gets a smaller grant at a much higher strike price, and sees less upside. One person understands taxes and exercises carefully. Another gets surprised by taxes and liquidity constraints. One person diversifies after the IPO. Another refuses to sell anything and becomes dangerously concentrated. The wealth event is exciting, but it creates a new problem. What do you do when one asset suddenly becomes most of your net worth? This is the part the internet usually ignores. Becoming rich on paper is not the same as staying rich. If a SpaceX employee wakes up with millions in company stock, that is incredible. But if 90% of their net worth is tied to one volatile company, they are not financially free yet. They are financially concentrated. There's a difference. Concentration creates wealth. Diversification protects wealth. The thing that made you rich is often too risky to remain your entire plan. That is a painful psychological transition. When a stock made your life, selling some of it feels like betrayal. You think, if I sell and it keeps going up, I will feel stupid. But if you never sell and it crashes, you may lose the freedom you already won. That is why many newly wealthy employees need a plan more than they need hype. They need tax planning. They need diversification. They need to understand lockups, capital gains, alternative minimum tax, concentrated stock risk, estate planning, and whether their lifestyle should change at all. Because sudden wealth can destroy people almost as fast as poverty can. Not because money is bad, but because money reveals every weakness in a person's decision-making system. Someone who never had money may suddenly feel pressure to buy a bigger house, help every family member, prove success, invest in random deals, or live like the number can never go down. And that is how a once-in-a-lifetime equity event becomes a temporary lifestyle upgrade instead of permanent freedom. The smartest SpaceX employees will probably not be the ones who buy the flashiest cars after the IPO. They will be the ones who quietly convert concentrated paper wealth into durable financial independence. They will pay the taxes. They will sell gradually when allowed. They will build a diversified portfolio. They will keep enough cash to sleep. They will avoid pretending they are venture capitalists just because their stock went up. They will understand that the goal is not to maximize bragging rights. The goal is to turn one extraordinary outcome into a life that cannot be easily taken away. And that brings us to the second group in this story, retail investors. Because while insiders may be getting rich, regular investors are asking, should I buy SpaceX? That is a much harder question. SpaceX is not a normal company. It has a powerful brand, enormous ambition, and businesses that could reshape entire industries. But a great company is not automatically a great investment at any price. Price matters. Valuation matters. Expectations matter. When a company comes public at a valuation above $1 trillion, the market is not pricing a small success story. It is pricing in massive future success. That means the company has to keep executing at an extraordinary level just to justify the starting price. For early employees, the big valuation is the reward. For new buyers, the big valuation is the hurdle. That difference is everything. If you bought a house for $200,000 and it is now worth $1 million, you are in a very different position from the person buying it from you at $1 million. You can both believe in the neighborhood. You can both think it is a great property. But your risk is not the same. The early buyer has embedded gains. The new buyer needs future appreciation from a higher base. That is the exact mental model people should use with SpaceX. The company may be historic. The mission may be extraordinary. But investors should not confuse admiration with analysis. You can admire the rockets and still ask, what am I paying for this cash flow? You can believe Starlink is important and still ask, how much future growth is already priced in? You can respect Elon Musk's execution history and still ask, what happens if expectations are too high? This is not negativity. This is investing discipline. The public market has a way of turning great stories into dangerous entry points when excitement outruns fundamentals. And IPOs are especially tricky because the early sellers, underwriters, institutions, employees, and insiders often have very different incentives from the everyday buyer. Even when an IPO includes a retail allocation, regular investors still need to understand that they are not early in the same way employees were early. They are arriving at the moment when the story is already famous. Sometimes that still works. Sometimes world-changing companies keep compounding for decades after going public. But sometimes the first public buyers spend years waiting for the valuation to catch up with the hype. Both outcomes are possible, and the only honest answer is that nobody knows for sure. What we do know is that the employees getting rich in 2026 are proof of a bigger principle. Wealth rewards ownership, patience, and asymmetric upside. Asymmetric upside means your downside is limited, but your upside can be huge. An employee equity grant can be worth little or nothing, but if the company becomes SpaceX, the upside can be life-changing. A small ownership stake in the right business can outperform years of ordinary saving. But the hard part is getting access to that ownership early enough, surviving long enough, and not selling at the wrong time because life got expensive. This is why wealthy families talk about assets, not just income. They teach their kids to ask, what do I own? Not just, what do I earn? The SpaceX story is simply a dramatic version of that lesson. A person who earns a high salary but owns no assets has to keep working to keep the machine going. A person who owns appreciating assets has a second engine building wealth in the background. For SpaceX employees, that second engine may have been quietly running for years. In 2026, the engine becomes visible. And for some of them, it may be loud enough to change their family tree. Think about that. A technician who held equity might pay off a mortgage. A software engineer might fund college for children who are not even born yet. A former employee who resisted selling might become financially independent before 40. A cafeteria worker or operations employee with stock exposure might have a net worth that shocks everyone around them. And the outside world will call it overnight success. But it was not overnight. It was deferred compensation, risk, patience, and ownership. It was years of believing that a tiny slice of something massive could one day matter. Now, there is another uncomfortable lesson here. Most people will not get this opportunity at their job. Most companies do not become SpaceX. Most employees are paid wages, not meaningful equity. And even when they receive equity, it is often too small, too late, or too restricted to change their lives. So what can the average person actually learn from this? The lesson is not go work at SpaceX. The lesson is to build ownership wherever you can. If your job offers equity, understand it. If you invest in index funds, keep buying ownership in productive companies over time. If you build a business, even a small one, you are creating equity. If you develop skills that let you negotiate profit sharing, partnership, royalties, or ownership, you are moving from labor to leverage. The SpaceX story is dramatic, but the principle is ordinary. The people who own the asset benefit most when the asset becomes valuable. That applies to startups, stocks, real estate, private businesses, intellectual property, and even online channels. The world pays workers once. It pays owners repeatedly. That sentence might sound harsh, but it explains why so many hardworking people stay stuck. They work, get paid, spend, repeat. There is no asset compounding behind them. The SpaceX employee also worked, but part of their compensation became ownership. And once ownership starts compounding, time works differently. A paycheck is spent $1 at a time. Equity can reprice all at once. That is why a person can look financially ordinary for years and then suddenly appear rich. The wealth was not visible because it was trapped inside an asset. The IPO simply unlocked it. So when you see headlines about SpaceX creating new millionaires, do not just feel envy. Study the mechanism. Ask what they owned. Ask when they got it. Ask what risk they took. Ask how long they had to wait. Ask whether the public buyer is getting the same deal or a totally different deal. Because the surface story is rockets and billionaires. The real story is ownership and timing. And this is where I want to be very clear. I am not telling you to buy or avoid SpaceX. This is not financial advice. I am saying that the people most likely to get rich from SpaceX in 2026 are not the people chasing hype after the fact. They are the people who were already on the cap table before the party became public. They are the ones who accepted equity when it was illiquid, uncertain, and boring to talk about. They owned the story before the story became obvious. That is the lesson. By the time everyone is talking about an opportunity, the easiest money may already belong to someone else. But that does not mean you are helpless. It means you need to think like an owner earlier. You need to stop looking only for the next hot ticker and start asking where you can build or buy ownership before the world fully prices it in. Sometimes that is a job with real equity. Sometimes it is consistent investing when markets are boring. Sometimes it is building a side business. Sometimes it is buying assets when nobody is excited. Wealth usually looks boring before it looks obvious. SpaceX equity probably looked boring to some employees for years. Then 2026 arrived, and suddenly the world understood. And if there is one sentence to remember from this video, it is this. The public sees wealth when it becomes liquid, but the owner built it while it was still invisible. That is why hundreds, maybe thousands, of people are about to get rich off SpaceX. Not because they found a magic stock, because they owned a piece of the future before the future had a public price. And for the rest of us, the question is not whether we can go back in time and join SpaceX 10 years ago. We cannot. The question is whether we are building any ownership today that our future selves will be grateful we did not ignore.